Okay, thanks very much, Amanda. Um, I appreciate getting this invitation to talk to your group today. I have quite a lot to say about what's going on. So let me start straight away with, hang on just a minute, I need to, having problem forwarding my slides, Amanda, if you just like to hang on just a minute there, if you don't
Yeah, no
mind.
worries.
I'm just going to stop sharing, try to figure out what's going on. Uh, Sorry about that, everybody. There's always technical. Yeah. Amanda, can I just ask, can you see that okay?
Yep, I can see it.
Great. Let's try again. So today I'm going to talk broadly about current US trade policy. What's the impact? Necessarily, this is a moving target to some extent, as many of you probably realize. And it's in many ways, it's about as up to date as I can make it, but I did have to cut off trying to include any additional information as of early this week, simply because the presentation would get hugely out of hand otherwise. So here's the outline of what I'm going to talk about so that you know broadly where I'm going, and maybe this would help um, listeners get some sense of where they might want to ask questions. So first of all, I'm going to give you an outline of the key US trade policy choices that have been made since the administration came into office. And then I'll talk a little bit about the broader macroeconomic impact of tariffs, because I think that it's important to see tariffs in that broader context and how those broader macroeconomic impacts could affect the agricultural economy. And then I'm going to give you a trade outlook for US agriculture with respect to the tariffs, and I'll try to say a little bit about how it might affect the agricultural sector here in our state of Ohio. And then I have some additional considerations that relate to other things that I think might matter to agricultural trade. And then also, given my interest in trade law and trade negotiations and trade agreements, I want to give you sort of my personal view at the end of what's going on and how that affects our trading relationships and the functioning of the World Trade Organization in particular. So I'm going to first of all give you a very quick rundown of the sequence of tariffs. And you can see that I began on February the 5th, sorry, and took it through to last Friday, April the 11th. And on the back end of these notes, I got a link to the Peterson Institute, who do a fabulous job of tracking all the tariffs and how they've been introduced and the timeline of what they've been introduced. So this is a stripped down version of what they have way more details on than I can possibly present in a webinar. So in early February, we started out with the 25% tariff on all steel and aluminum imports into the United States. In fact, these tariffs were originally implemented during the 2018, 2019, 20 trade war that began under the first administration for President Trump. Some of those import tariffs were removed for a period and they've simply been reintroduced, and the tariffs are actually about 5% higher than they were. And then I'm not going to give you the dates, but this is just the sequence. This was followed by 20% tariffs across the board on Chinese imports. And this was on top of the tariffs that were already imposed on China in 2018, 2019. And I'll show you that tariff sequence later on in the presentation. At which point China initially retaliated with very specific tariffs that related to agriculture. There were other tariffs, but I thought you might be interested to see what they were targeting initially. So 15% on chicken, wheat, corn, and cotton. Just to put it in perspective, corn is probably our second largest export, sorry, to China. And then they placed 10% tariffs on sorghum, soybeans. Soybeans are our number one export, both from the state and for the US in aggregate to China, pork, beef, seafood, fruit, vegetables, and dairy products. That was followed by a 25% tariff on our imports from Canada and Mexico, but these were subsequently relaxed as long as the products were covered by the USMCA, that used to be called NAFTA. It became USMCA after President Trump renegotiated that agreement in 2020. The rules of origin relate to the extent to which a product is using inputs that come almost exclusively from North America, and they would typically be subject to a zero or a very low tariff. And these are very important for trade in automobiles, where you have to have something like approximately 80% of the inputs in an automobile, say being imported from an assembly plant in Mexico, has to contain about 80% of inputs manufactured in North America, comes in at a very low tariff. If it doesn't meet those rules of origin, it will be subject to that 25% tariff. Moving along in the tariff sequence, Canada and the European Union, they negotiate against the steel and aluminum tariffs imposed against them by the United States. And then I think one of the most important tariffs that was imposed related to automobiles and auto parts, again with USMCA exemptions, because otherwise we have a highly integrated automobile market here in North America, and 25% tariffs against Canada and Mexico would have seriously disrupted production in that industry. Then on April the 2nd, this was President Trump's so-called Liberation Day. The administration introduced what were called reciprocal tariffs with a 10% baseline. So, for example, my home country, the United Kingdom, was only subject to a 10% tariff, which is the baseline tariff. On that day, there were significantly higher tariffs that were levied against other trading partners, and I'll show you some numbers in a couple of slides from now that give you a sense of the range of those tariffs. China immediately retaliated with 34% tariffs on US exports. The administration then responded with an additional 50% tariff on Chinese imports. China then retaliated with an extra 27%. So we have a tit for tat ratcheting up of the level of tariffs between the United States and China. And then I think it was April the 9th, the administration announced that they were going to reduce all tariffs on countries other than China to 10% for 90 days on all countries except for China. So those reciprocal tariffs for the moment have been reduced to an across the board tariff of 10% against all our trading partners except for China. And most recently, the tit for tat tariff war, if you want, between the United States has reached the point where the United States now has a 145% tariff against all imports from China, and a 125% import tariff has been imposed by China on exports by the United States. As a trade economist, we've never seen tariffs of this level, and I would suggest that they're getting close to being prohibitive, in the sense that there's a very strong potential that they could actually choke off trade pretty significantly between these two largest economies in the world. So the first thing I wanted to show you, and this this graphic is very interesting in the sense that trade economists for a long time had never really thought about the extent to which trade policy could generate uncertainty for firms investing in the export market and firms actually choosing to export. And prior to the first trade war, there was a period of about 5 years when there was a significant number of papers got published in the economics journals about how institutions like the World Trade Organization and its predecessor, the General Agreement on Tariffs and Trade, along with there's over 340 free trade agreements now that have been reported to the WTO around the world. And the combination of those institutions and the effect they've had on cutting tariffs, imposing upper bounds on the tariffs that people set, and the extent to which trade has been liberalized has led to a significant reduction in uncertainty on the part of investors and traders about the future of trade policy. And that shows up in empirical analysis that it did actually help to increase trade. Now, the St. Louis Fed has been constructing an index of trade policy uncertainty now for a number of years, and their data go all the way back to 1960. And you can see that over the period 1960 through to around about 2018, yeah, the index sort of moved around, but it wasn't particularly volatile, and you didn't see any particularly large spikes. But you'll notice that 2018, 2019, you see a big uptick in the level of trade policy uncertainty. And as you can see from the beginning of 2025, Q1, that trade policy uncertainty index is the highest that it's ever been. And that's kind of the way this is affecting me and even how I think about these issues, is that from day to day, I do not know what is going to be on the agenda for a tariff or tariffs, what countries are going to be involved, are they going to be pulled back, are they going to be raised, et cetera, et cetera. And it's interesting that the literature on trade policy uncertainty picked out two metrics for how you might measure it. One was trade policy volatility, and by that, researchers meant frequent changes in tariffs. And I think we've been observing that over the last couple of months, is frequent changes of the level of tariffs, the countries against which they're imposed. Are they going to stay? Are they going to be pulled back? And secondly, the second metric for trade policy uncertainty is the outbreak of a trade war. And prior to 2018, we hadn't had a trade war pretty much since the 1930s. So those two metrics have now been met. And if you read the media, such as the Wall Street Journal, the Financial Times, the Economist, the New York Times, they're all pointing out to the extent to which people wishing to invest in trade and production are facing significant uncertainty. And if you think of it as an option problem, firms are backing off taking out that option. So I think it's a bit early to see this showing up in the data, but I think this is going to affect both the volume of investment in export markets and the actual volume of trade. So I think this is very important as we think about the future and the next couple of years, is the extent to which this is going to affect global economic activity and trade in particular. Let me talk a little bit more about reciprocal tariffs. So it's important to remember that prior to the first Trump administration, the US had actually been the leading force globally in pushing for lower tariffs through what was originally called the GATT, which was originally signed. That's a multilateral agreement which was originally signed in 1947, and its successor, the World Trade Organization. There are now 166 members of the World Trade Organization, including China, who acceded to the WTO in 2001. But the two pillars of the WTO and its predecessor, the GATT, are reciprocity, and this is the definition of reciprocity that trade economists and trade lawyers and trade negotiators follow. This was the tariff cutting formula that was adopted by countries negotiating in Geneva, and it was based upon what we call a balance of concessions in trade negotiations. So in any round of trade negotiations, there will be a formula by which countries agreed on average to lower their tariffs by a particular percentage. And so, for example, in the Kennedy round, which was in the mid-1960s, on average, tariffs were cut by 38%. And I think in the Uruguay round, which ended in 1994, tariffs on average were cut by 35%. So what reciprocity means is that you don't cut all tariffs by the same percentage, you cut tariffs on average by a certain percentage, which means that some products will have lower tariffs than other countries if we're comparing the United States, say, with the European Union. So trade negotiators understand reciprocity in a very particular way. The second major pillar of the WTO and its predecessor, the GATT, has been that in negotiations, countries agree to bind their tariff cuts to a particular level, and they agree not to unilaterally raise those tariffs. But most importantly, if the United States on average has, say, tariffs of 4% against all its trading partners, it agrees to apply 4% on average to every single one of its trading partners. So it doesn't have a higher average with respect to China than it does to, say, to the European Union or to other trading partners. And these are called the most favored nation rates. And I'll come back to that in my concluding slide when I give you my own particular thoughts on where we're going with multilateral trading institutions as well as free trade agreements, which we'll talk about later. So as of now, the effective US tariff is about 26, 27%. I was on an NPR panel yesterday up in the Cleveland area, and my co-presenter came from the Yale budget group, and his estimate was about 27%. So that 26.8% is pretty close to what he was suggesting. The point is this effective, so this is basically the average of all tariffs that the United States has explicitly set against our trading partners up until last Friday. And what's important to understand is that these tariffs bear no relation to the United States or any other country's average WTO bound tariffs. So the use of the word reciprocal by the administration does not really tie up with the definition of reciprocity that's been consistently used in trade negotiations multilaterally since 1947. So this is another point, and I don't want to spend too much time, and I'd be very happy to come back and answer questions about this. In setting these reciprocal tariffs, there was a huge amount of focus on the bilateral trade deficits a country had with a specific country. And many of you may have seen the formula that was applied to other countries' tariffs to figure out how we could reduce our bilateral trade deficits with any specific country. It's important to understand that macroeconomists, I'm not a macroeconomist, but I'm trained in that area, is that the trade deficit should be seen in terms of the overall trade deficit. And remember, we've been running a trade deficit here in the US since the 1980s, and particularly this evolved under the presidency originally of President Reagan. It's a macroeconomic phenomenon. It's not going to be resolved by tariffs unless we simply stop trading with the whole world. The overall trade deficit is a function of the difference between national savings and investment, and consistently US investment has outweighed our national savings rate, and consequently we import more goods than we export. Although I should point out that we actually have a trade surplus in services, even though we have an overall trade deficit in goods and services. So I got this graphic actually this morning. I think it was in the Financial Times from the IMF. This shows you the history of US effective tariff rates. And you can see that in the very early period of the US as a country, tariffs were on average just below 60%. You can see the famous Smoot-Hawley tariffs in the 1930s averaged about 35%. The GATT tariffs in 1947 tariffs were averaging somewhere around 18, 19%. And US average tariffs before the first trade war with China were averaging around 4%, and 4% with the rest of the world. In fact, globally, tariffs average around 4%. And then you can see those tariffs by last Saturday kicking up to 27%. Now, it's important to understand that the tariff rates that are being implemented by the administration and the way they calculated those reciprocal tariffs don't actually bear much relation to global average tariff rates. These would be the tariff rates that countries have committed to under the World Trade Organization, and these are what are called their most favored nation tariff rates. So you can see over there on North America that the United States average tariff under the WTO is 2.2%. Our trading partners in Canada and Mexico a little bit above that at 3.4, 3.9%. If you look at our European trading partners, those tariffs on average about 2.7%, 2.7% for countries in the EU, 3.3% for the UK since it left the EU with Brexit. But then as you go towards looking, and Australia is 2.5%, we actually have a free trade agreement with them as well. But what you'll notice is on average, our tariffs with our developed country trading partners, such as the EU in the Northern Hemisphere, Australia in the Southern Hemisphere, are pretty similar. Our tariffs with our trading partners in North America are pretty similar on average. The differences come in when we look at developing countries such as India. China's pretty low at 3%. They were pushed pretty hard to cut their tariffs when they came into the WTO. But a lot of that is related to the fact that these are developing countries and they've often been given what's called special and differential treatment in the GATT stroke WTO in order to help their development. Again, if you'd like to ask me a question about that later, please do. I don't know how clear this figure comes out. Excuse me while I just take a drink. These are the reciprocal tariff rates that were initially implemented on April the 2nd. So you can see Australia would have had a base rate of 10%, just like the UK. But if you can pick out some pretty high ones that have been levied against Cambodia, 49%. Let me see, Vietnam, 46%, Sri Lanka, 44%, Myanmar, 44%. These are all developing countries, very low income per capita countries that, for example, Cambodia is pretty good at producing children's clothes. Nike produces shoes in Vietnam. And it's very interesting to see the way that these reciprocal tariffs played out. But remember, bar China, all of those tariffs have been reduced for 90 days as of April 9th to 10%. So that's pretty much what I want to say about where we are with tariffs. And please ask me any questions you might have about that in the Q&A. I want to move on to talk about the macroeconomic impacts. Many of you, if you read the business pages of the Wall Street Journal or the Financial Times, or you watch Bloomberg financial news on TV, are probably well aware of these macroeconomic impacts, but I think it's important just to reinforce what we think might happen and what has already happened. So again, referring back to my colleague from the Yale Budget Lab, who I was online with on NPR yesterday, with all tariffs in place, so that would be all the tariffs that have been implemented so far, US GDP is forecast to fall effectively by $170 billion a year permanently going into this year. So that's an important hit to the US economy. So that's a once and for all reduction in GDP. And other forecasters are generating very similar numbers. At the same time, there's a potential for a one-time increase in the rate of inflation to 2.9%. My Yale budget colleague suggested it was about 3%. And that all assumes no policy changes by the Fed. And if you're interested, we can talk about the Federal Reserve and what it might do later and what Jerome Powell has been saying this week. But there's clearly going to be, everybody expects there to be some kind of impact on the rate of inflation. And with tariffs, these are a one-time increase in tariffs. So it's going to generate probably a one-time increase in prices. There might be follow-up increases. but it's not clear the extent to which that's going to happen. I'm going to show you some graphs in a minute to back up these bullet points. Consumer sentiment has fallen significantly, so consumers are much more worried about their budgets. They're worried about a recession. They're worried about the extent to which unemployment might begin to increase. And I'll show you the numbers from the University of Michigan, who puts together that sentiment index that you might have seen in the media. It's also important to understand, and maybe this is something that economists like myself pay attention to, but tariffs are highly regressive. And that really derives from the fact that um, consumers on lower per capita incomes spend a higher proportion of their incomes on what we call traded goods. So that would be goods that are imported into the United States and they might purchase in Walmart or Target or buy online through Amazon or some other online shopping app or site. So that means that the impact of tariffs on prices and hence on purchasing power is going to hurt lower income consumers more than those at the higher end of the income distribution, where those of us at the say the upper 10% of the income distribution or upper 20% of the income distribution would spend a higher proportion of our income on what we call a non-traded goods. So these would be services like going to the ballet or the theater or a rock concert or a football game or a basketball game, etc., etc. So these are products or services that are not traded internationally necessarily. And also, you may have read about the removal of the de minimis exemption. The de minimis exemption was if you purchase goods, say online, to a value up to $800, they would not be subject to any taxes or tariffs at the border. And this was actually this actually helped consumers on lower incomes, who, as I've just said, disproportionately consume traded goods compared to higher income consumers. So it's expected that if this de minimis exemption is removed, most notably from imports from China, it will mostly hurt low income households. In other words, it will intensify that regressive effect of higher tariffs. Finally, and there's a lot of discussion about this, the idea, and I'll talk about this in a bit more detail in a minute, but I'm going to suggest to you, and this is based on research by very credible macroeconomists, that let's suppose the United States implemented a 50% tariff across the board. We're not there yet. We're averaging nearly 30%. And we can see from the graphic I'll show in a minute how much revenue that could raise. It's important to understand that that's only going to generate revenues of about 40 of about less than 40% of what federal income taxes currently generate. So federal income taxes consist of what you and I have just completed our 1040 forms for the IRS, but it also includes corporate income taxation. And that's $2 trillion a year in total, those the federal income tax take. So let me show you a few graphics here. So this is the Yale Budget Lab's forecast of US real GDP level effects of 2025 tariffs to date. And you can see that they expect a pretty significant reduction, minus 1.6 percentage point reduction in GDP as we move into 2025. It takes 2 or 3 years for that GDP to move back up, and then assuming nothing else changes, it sort of flattens out there at a continuous or in perpetuity without other changes, a negative 0.8% reduction in GDP. So these tariffs mean that we would never actually recover the level of GDP that we currently enjoy here in the United States. So this would be a one-time reduction. And you can see that by the definition of recession, if this actually pans out, you need 2 successive quarters of a decline in GDP. So essentially, these guys are predicting a recession. If we look at the global level, this is a slide I saw produced by the World Trade Organization a couple of days ago, and they're looking at changes in the value of real exports and changes in the value of real GDP. So this is the value of world trade, this is the value of world GDP. And as you move leftwards, you can see that you get increasing negative impacts on both trade and global GDP. So if you remember what I said about trade policy uncertainty, if we just had this ongoing uncertainty, you see a not immodest decline in the real value of exports and a modest decline in the value of real GDP. But if you actually plug in the tariffs as of the 14th of April, you get a 3% decline in global trade and about a 0.45%, 0.5% reduction in the value of global real GDP. And then if you add in reciprocal tariffs, you get bigger increases in the reduction of trade and GDP. And then if you get trade policy uncertainty spreads globally, in other words, are the EU going to retaliate? Are Mexico and Canada going to retaliate, et cetera, et cetera? You get an even bigger hit. So I think this is a pretty good graphic that tells you that global trade has the potential to take a real hit from an intensifying trade war between the United States and the rest of the world and the hit to global GDP. So it looks like there's a very high probability of a modest to a significant global recession with all the feedback effects here into the US economy. This graphic just shows you and I won't spend any time on this in great detail, but what that shows you, the darker bars and the light blue bars are larger as you go to the bottom end of the income distribution. In other words, folks at the bottom end of the distribution stand to lose more than those at the top end of the distribution. But if you go to the median, that's what we call the fifth decile. That's taking you up to the 50th decile in the income distribution. If all the tariffs go into place, that's per annum, that's a $3,000 loss in disposable income. So that's a significant loss to folks on the bottom or the lower end of the income distribution. Here's that graphic from the University of Michigan of consumer sentiment. You can see that it took a big hit during the pandemic. It took a big hit during the Biden administration because of inflation. As inflation fell and the economy picked up, you can see that consumer sentiment rose, but you can see now it's taking a big hit with concerns about tariffs, the rate of inflation, and the potential for a recession. Here's the history. Let me say a little bit about US tariff revenue. This is the history of the use by the United States government as the contribution of tariffs to total government revenue. This goes back to 1795, almost all the way back to independence. And you can see that tariff revenue constituted a very large proportion of tariff revenue in the early days of the Republic. It actually hit 100% in the early 1800s. And that was because there was no income tax, federal income tax here in the United States. I'm not going to talk about the history of why it moved up and down, other than to say you can see that there was a significant reduction after the US Civil War, before the US Civil War. It grew again after the Civil War. A lot of that was due to the influence of Northern manufacturing on the Republican Party in raising tariffs to protect them particularly from European competition. You'll see that they rose again a little bit during the McKinley administration. And then the Smoot-Hawley tariff comes in there in 1930. And then you can see after the Second World War, pretty much tariffs disappear as a meaningful source of revenue to the US government. And this is the graphic I mentioned earlier. This is a slide that's based on forecasts, particularly by Maurice Dobsfeld, who used to be the chief economist at the International Monetary Fund, the IMF. And the line to look at would be the red one. That's the most meaningful estimate based upon how they believe demand for imports would respond to increases in tariffs. The vertical axis is the amount of revenue on average, sorry, annual revenue that could be raised from tariffs. And the bottom, the vertical, the horizontal axis is the percentage tariff rate. And what you can see is from that red line, it maxes out at around about 50%. That tells you that with a 50% tariff, that will be the optimal tariff to raise in terms of the amount of revenue you can raise. It raises just below $800 billion, which, as I told you earlier, is just less than 40% of the $2 trillion tax take through income taxes. And you can see that after that point, if you keep raising tariffs, and think about that China tariff is now over 100%, the rate at which you can generate revenue starts to decrease pretty substantively. And it's very, very simple. It's the law of demand. As you keep raising tariffs, the negative effect on demand becomes more intense. And there comes a point where at 100%, you're virtually zeroing out all tariff revenue because tariffs have become basically prohibitive. So what I'm saying there is, and it's not just me, it's most macroeconomists, is you cannot replace the federal income tax with tariffs. And these estimates are very static. They don't include the negative effect of tariffs on the rate of growth on the economy. So this is sort of a assuming everything else remains constant type of estimate. What about the impact on the US dollar? Well, on the one hand, economists predict that with US tariffs and either no or very little retaliation by our trading partners, basically, and I'll move through this a little bit quicker than my notes. The forecast is that the dollar would appreciate. That's because we demand less dollars here in the US because we're importing less, and foreigners demand more dollars because they're not fully retaliating against us. And so on net, the dollar appreciates. That would hurt exports, although the cost of tariffs to US consumers would be partially offset because our purchasing power has increased. With full retaliation by our partners, the effect on the dollar would be neutral. In other words, the change in the demand for dollars would not change, but American consumers would have less purchasing power due to the tariffs. And we've already talked about that. However, the dollar has actually depreciated because of the expectation that there's going to be a big shock to the US economy. And this has the potential to generate inflation due to the higher cost of imports, but it could aid exports. And one of the things you need to pay attention to, and many of you probably have noticed this if you worry about your portfolios, not just because of stock prices, but because of bond yields. So there's a very simple relationship in bond markets. The higher a bond prices, the safer they're considered by the market, the lower are yields. The lower are bond prices, the market sees them as risky, the yield goes up. And if the yield goes up, that puts pressure on what we call the term structure of interest rates. So that would go back into mortgage rates, car loan rates, bank interest rates, CD rates, etc. It doesn't affect the federal rate because that's set by the Federal Reserve. These bond yields are rising, and the bond prices are increasing because foreign investors are very uncertain about the status of the US economy. So if you were, let's say, a United Kingdom holder of US treasuries, 10-year or 30 years, and you decided the US economy, it's looking pretty risky to me. It's not as safe an asset as I thought it was. I'm going to sell. So you're selling a dollar-denominated asset that's going to push down the bond price. It's going to push up the yield. Because you're selling a dollar-denominated asset that's priced in dollars, it's going to put downward pressure on the dollar. So right now we have three metrics that are moving in a certain direction. The stock market is falling, or it has been falling. The dollar is depreciating, and bond prices are falling, and bond yields are increasing. So here's a diagram. You can see, you can go up to the beginning of 2025. You can see from end of March, early April, a pretty significant depreciation in the US dollar. This index is based on a basket of 10 currencies against the dollar. So the euro, the renminbi, that's China's currency, for example, would be included in that index. Here are US Treasury yields for both 10-year and 30-year bonds. You can see there was that significant increase in bond yields in early April. I haven't looked at the bond market today, but this is what Paul Krugman calls the bond vigilantes, really concerned about the security of investing in the US and the ability of the US to pay down its debt, which as you probably know, is at record levels right now. And I would like to note that the former Prime Minister of the United Kingdom, Elizabeth Truss, one of the reasons she was forced to resign from the UK government is that she made unfunded tax cuts, and it really spooked the bond markets, and they started selling bonds, and the UK Bank of England actually had to step in to the bond market to hold up those bond prices. Krugman rather rudely called that the moron risk premium. Now let me talk about agriculture. I think I'll allow myself about 15 to 20 minutes. Is that okay, Amanda?
Yep, we're on time, so sounds great.
Good. So this is where we move in. So I hope that was that's about as thorough a background I can give you in a relatively short space of time to where we are on the tariff sequence and the macroeconomic effects. And obviously the macroeconomic effects are forecasts, as are what I'm about to tell you about agriculture. So let me put this in some broader perspective. These are the most recent forecasts from United States Department of Agriculture and the Foreign Agricultural Service. The brown line is US agricultural imports in billions of dollars, and the green line is the value of US agricultural exports in billions of dollars. And you can see that up until about the trade war starting in 2019, 2018, for over nearly 20 years, the US had been running a trade surplus in agriculture, and this was often highlighted by the Farm Bureau and other ag stakeholders as a bright spot of US exports, that we were running a trade surplus in this particular industry compared to the fact that the US is running overall a trade deficit in goods at large. And then you can see around 2020, agricultural trade was almost balanced, but in the past couple of years, we've started to run a deficit. Now, that's partly driven by declining commodity prices. So we're losing on our soybean exports, corn exports, wheat exports, etc., because of lower global commodity prices. But nonetheless, that is a significant increase in the deficit. And this year, for 2025, USDA is forecasting a $49 billion trade deficit. So if you see the US export market as being important for the US agricultural sector, and in some sense important for the US economy at large, we're already facing a potential deficit in this sector this coming year, and that deficit is expected to grow over time. Let me say a little bit about, and by the way, these forecasts predate any of the tariffs being put into place. USDA will not be releasing a new forecast until early May. So if you're interested, you need to go onto the USDA website then, and you can see what their forecasts will be then. So this is without tariffs being in the picture. So this year, exports are forecast to be at $170 billion, down about $3.9 billion since last year. And if you look at that graphic, the table, you can see soybeans are forecast to be down 2.9 billion, corn 0.3 billion. We do a little bit okay on livestock, poultry and dairy, and horticultural products. Those numbers are worth remembering when I show you some forecasts by some colleagues of mine at North Dakota State University about what might happen to US agricultural exports if we have a full-blown trade war, not just with China, but the rest of the world. The next slide, sorry, the next bullet is very important. Our three most important markets, and you can see the numbers, are Mexico, Canada, and China. So our two most important markets are our North American trading partners in USMCA, and our third most, excuse me, our third most important market is China. The major concern back in February, and a concern that I'm going to argue is intensified, is we've experienced a loss of export market share in China due to their reduced import demand and competition. And there's a real concern about disruption to the North American trade, the North American USMCA market as well. To show the other side of the equation, this is the agricultural trade outlook for imports. So our imports are forecast at $219 billion. That's up $13 billion from last year. And what you can see there is the dominant import is horticultural, so that would be fruit and vegetables. And most of that is coming in from Mexico, sugar and tropical products, then livestock, poultry and dairy, and some grains and feed. That would probably be mostly canola coming in from Canada, I would imagine. Again, our key import suppliers are our two North American trading partners, Mexico and Canada. And then our third is the EU at $42.7 billion. So it's important to remember that if we retaliate against, if we impose tariffs against these three trading partners and they choose to retaliate, there's this important symbiotic relationship between our imports and our ability to export to their markets. A major concern here would be tariffs on imports from Mexico, if they were put into place, would drive up US fruit and vegetable prices almost immediately. You can see I have a little graphic up there in the corner. Those are avocados from Mexico, to paraphrase the advertising slogan. I had a lot of journalists calling me about this early to mid-February, and we import about 90% of our avocados from Mexico. The rest is supplied by California, and we also import some from both Peru and Ecuador. So kind of watch this space on whether or not we ratchet up tariffs in the US against Mexico, because I think it would have an immediate effect on grocery prices, especially in the produce aisles of the grocery store. So here's a graphic of the US-China trade wars. I'm going to call it Trade War One, Trade War Two. These are data supplied by the Peterson Institute for International Economics. And you can see there that at the beginning of the first trade war in 2018, our tariffs against China averaged about 4%. China's tariffs against us averaged about 8%. Those tariffs were then ratcheted up by mid to late 2019 to, 2020 to about, let me see, China was about 21%, US about 19%. Those were average tariffs. The Biden administration never removed any of those tariffs. China did actually waive several of its tariffs, and I'll talk about that in a little bit more detail in a minute. And then you can see, and hopefully you can see my little Adobe hand there on the screen. These tariffs just go up vertically. So they go up from about 20% to 147 and 134% respectively for the US and China. This is beyond historic levels. I mean, these are prohibitive tariffs in my view. But we obviously await to see what's going to happen to trade trade with respect to manufacturing and trade specifically with respect to agriculture. So the impact of the first round of the trade wars, so that would be 2018, 19, 20, our agricultural exports were disproportionately affected. China targeted our exports of soybeans and corn. There's no doubt they did this. It was very strategic, and it was because of the fact that much of the support for President Trump came from Midwestern states where these commodities are typically produced. So that was the reason for targeting, and it was one of our most important exports to China, albeit low value. low value added, I should say. So the agricultural sector was estimated per annum to lose $14 billion worth of agricultural export revenue. And that's a study out of Virginia Tech and the Economic Research Service of USDA, with damage to soybean exports dominating at about $10.7 billion. Farmers, though, were compensated through what was called the Market Facilitation Program. So between late 2018 and about 2021, when the program ended, farmers in the United States received compensation. These were lump sum transfers, what are called ad hoc payments of $23 billion. So their balance sheets were partially protected from the trade war by compensation they received from the US government at that time. Then in early 2020, the United States and China negotiated what was called the US-China Trade Agreement, or USCTA for short. And at that point, China granted annual waivers on their tariffs, both on agricultural imports and manufacturers, reducing them to their MFN rate. So what that meant was that even though they'd raised their tariffs on average to 19%, if you applied to the Chinese government, they would waive their tariffs, say, on an import of a shipment of soybeans. And so those tariffs went back down to the MFN rate on soybeans. So they went back from about 27, 30% back down to 7%. So that helped. And at the same time, in this agreement, China agreed to increase their agricultural imports over the period 2020 to 21. They only met 77% of the target, but that was a stimulus at the time to our agricultural exports, according to the Peterson Institute. Very quickly, this graphic, if you look at my hand, you see the big increase in agricultural tariffs during the trade war to about 35% on average against commodities. This trade agreement comes in, they drop down to about 11%. And those waivers have remained in place until the new administration came into office and started applying new tariffs to China, to which China then retaliated. So this leads into probably one of the main takeaways I want you to think about as I finish off my presentation. This is a graphic due to Joe Glauber, Dr. Joe Glauber. He was former chief economist for USDA. Basically, if you look at let's look at the orangey brown line, that's for soybeans. Even before the trade war, we were already losing, or our share in China's imports was declining. You can see for feed grains that the trade war took a pretty big dent out of our share of China's imports. It didn't affect our share quite as much as you might have thought for soybeans. It then grew again for both until about 2021, 2022. And that's because of this trade agreement, and also because China was rebuilding its hog production capacity after it had suffered from African swine fever. So they needed a lot of animal feed for a couple of years. But then you can see a significant decline in our shares in both soybeans and feed grains. And that share has been going to Brazil. So you can see Brazil has seen this meteoric rise in its exports to China of soybeans. This is in metric tons. And you can see that the United States is steadily losing market share to Brazil. Why is this happening? Well, Joe Glauber reckons the US has reached its technological capacity to grow more soybeans. We might increase yields, but our acreage is pretty much fixed now. And you can see that Brazil is continuing to harvest a greater and greater area for soybeans. So they are going to steadily replace us, I think, as our major export competitor in China, which will then be exacerbated by the trade war. You can see their yields. This is from FarmDoc. That from the University of Illinois. The Brazilian yields are converging on US yields. So they're getting to be as productive as we are here in the United States. So they're planting more soybeans and their yield of soybeans is increasing. And this year, they're expected to produce more soybeans than they did last year. And you can see they simply dominate production in Latin America. The second largest producer is Argentina. They're particularly important in processing soybeans into soy meal. Paraguay has modest exports, as does Uruguay. So now let me say something about what might be the impact of trade war two on the agricultural sector. These are forecasts by some colleagues of mine at North Dakota State University that they made in late 2024. They published this as a farm doc paper at that time, and it also came out in a peer-reviewed journal called Food Policy. And I'll send Amanda the farm doc paper for any of you that might be interested in reading that. In fact, I've got a link to that paper at the end of my slides. So let's focus on scenario two, which I think is about the closest to where we are right now. In November 2024, when I gave a talk, and I'm pretty sure Alan Lines is online, he would have heard this talk. At the time, I was accused of scaremongering or fearmongering. I'm not so sure that I am now, although you should remember that there's always a risk of forecast error. I.e., no forecast is perfect. It's not crystal ball gazing, but there's still, a risk that you get things wrong in the forecast. So you can blame the guys at North Dakota State if these forecasts are wrong. So this scenario has the US levying 10% tariffs against the rest of the world. That's pretty much what's in place. And let's assume the rest of the world retaliates with 10% tariffs across the board. And that could well happen. At the same time, the US levies 60% tariffs against China, and China levies a 60% tariff against the United States. Right now, those tariffs are twice 60%, 147% for the US, 135% for China. So I now think these numbers are potentially a lower bound. They might even be not the most aggressive forecast you could come out with. So these guys are forecasting in 2025 that would lead to annualized losses of $60 billion. So that compares to that $14, $15 billion of losses per year back in 2018, 2019. So that's a fourfold increase. You can see that this is dominated by the loss to the soybean sector, about $15, $16 billion, then corn, and then you can see how those track down. The other column is what would happen if we have a trade war with Mexico and China. And you can see that the losses are not quite as significant. But I think scenario two is a more realistic scenario and could even be worse. At the state level, the same study, and this is a graphic straight out of their paper, if we look up that top left-hand quadrant, that shows you the projections for 2025. If all the tariffs are in place, the expectation is that the Ohio agricultural sector would lose $1 billion of lost export revenue in soybeans and about $171 million losses in corn. And you can see as you go out into the Midwest, it goes from brown to orange to red. So the losses would be even larger as we move out into the major soybean and corn producing states in Indiana, Illinois, Iowa, Nebraska, Minnesota, and the Dakotas. If you look down in the left and bottom and right bottom quadrants, you see that for beef, it's dominated by all those feedlots down in Texas and Nebraska and Kansas, and to some extent Oklahoma. Wheat, mostly Kansas, North Dakota, Montana, and Washington. So that gives you some sense of what state level export loss projections could be, and that's just for 2025. I think what's more helpful to look at, not just the export revenues, because export revenue is going to be price times quantity, and that is that if we start losing even more market share in China, and we have a hard time diverting our exports to say, the European Union if they retaliate. And I'll have some additional comments about that on my closing slides. But this is very interesting. This is a study commissioned by the American Soybean Association last fall and the National Corn Growers Association. And they forecasted the impact on the price of soybeans and the price of corn. So that's in dollars per bushel. So let's just focus on soybeans, which is the left-hand graphic. So if China, and this is based upon either a 60% tariff implemented by China, or China simply gets rid of its waivers and their tariffs go back to about 35% on imports of agricultural commodities. And you can see two effects. China's price significantly increases from the baseline because they're diversifying away from the United States to other suppliers. And those other suppliers, particularly Brazil, would see a big increase in their export price. And that's because China is shutting off the flow of imports from the United States and is having to shift its imports and generate an incentive to get more imports from Brazil and Argentina. At the same time, because the United States loses market share in China, that leads to a pretty significant decline in the price that American farmers would receive for their exports of, say, soybeans if China were to implement a 60% tariff. Same holds for corn, although the price changes are not quite as great. So I think that's a pretty telling slide, and I would say these again are potentially lower bound estimates compared to back in November, where I just said maybe these are what you might call upper bound estimates, and maybe I could have been accused of fear mongering at that time. So now let me talk a little bit, and I've nearly finished, Amanda, about some additional tariff impacts that you need to take into account as we think about both sides of the ledger, because up to now I've talked about price effects, export market effects, and that's all due down to the effect of retaliatory tariffs against the United States, notably by China. So I think there's a clear potential for increased pressure on farm input prices. And by that, I mean fertilizers, energy costs, and potentially machinery costs. And I think the possibility or not of implementing anything like a 10% tariff on imports of potash from Canada would be rather critical. So we have three major fertilizers, NPK, even if you only put fertilizers on your backyard, predominantly nitrogen, but potash is important. And Canada accounts for more than 80% of our total imports of potash. Here's another farm doc diagram for you. The red columns, sorry, the red part of the columns, that's how much we're importing from Canada. So if we did place a tariff on and I think the tariff is being removed temporarily, that would really push up input prices, along with potentially price increases in things like urea, which is a nitrogen-based fertilizer, which we would import from the world market. We import a goodly amount of crude oil from Canada, which then gets refined here in the United States. If a tariff is put in place on that, about 10%, that's going to push up diesel prices, which would affect the bottom line for farmers. And finally, farm machinery costs are likely to rise in the medium term because of steel and aluminum tariffs. You can then add on port taxes. So the US has put in place a port tax on any ship that was built in China or any Chinese flagged merchant vessel. And some of these vessels stop off in multiple ports here in the United States. Obviously, with agricultural commodities, it's typically going to be New Orleans or possibly the West Coast. That would be Long Beach or Seattle. That's already raising export costs. And I've seen that's going to be then passed back to American farmers in lower prices they're going to get at the elevator, I suspect. So farmers are already facing a squeeze on their margins. They've seen falling commodity prices. They've seen rising input prices. And that was happening even before the trade war started to get ratcheted up. So I think that puts extra pressure on farm margins. So what are my other considerations? So I have two slides, Amanda, and then I'm finished. So first of all, if you remember, I mentioned earlier that um, the US government in the first trade war pumped $23 billion into the farm sector to compensate farmers for the Chinese retaliation against particularly soybean imports. A question that you might ask is how much will the administration be willing to compensate farmers for this time? In other words, will there be a market facilitation program Mark II? I don't know the answer to that question. It was kind of a rhetorical question. I have heard the current Secretary of Agriculture indicating that there might be such a program put in place, but I do not know what the political and economic feasibility of doing that for a second time. Bearing in mind that the previous administration put in place $10 billion worth of compensatory payments in late 2024 to make up for the fact that commodity prices are falling and the Farm Bill reference prices for things like beans and corn had not been increased because we don't have a new Farm Bill yet. And there's a lot of uncertainty about when we're going to get a new Farm Bill. Secondly, the North American Free Trade Agreement, or USMCA, is up for review in 2026. There is actually what's called a sunset clause, that if all the partners, US, Canada, and Mexico, do not agree to extend the agreement in July 2036, the agreement ends. And it's going to be reviewed for the first time next year. And if the partners cannot agree to renew it, it then goes up for review yearly until 2036. And if they can't agree to renew it, it will disappear. And here's where I'm very concerned. I think it's very critical to maintain access to our USMCA partners. They're our two largest export markets. Any newest tariffs could really undermine the integrated nature of the North American agricultural market. Mexico is a very important destination for US yellow corn, going into poultry, beef production, pork production down in Mexico. We export about 45% of our corn to Mexico, and that's the most recent numbers I've seen. If we start a trade war with Mexico and Mexico retaliates, that's going to hurt, in my opinion. And at the same time, I think it would really damage potential negotiations on maintaining USMCA. Why would Canada and Mexico be willing to renew an agreement where the other major trading partner is unilaterally raising tariffs in violation of an agreement that was signed as recently as 2020? So I think it's, thinking about the bigger picture, given the trade deficit we have in agriculture, given what's potentially going to happen in China, et cetera, it's very important for the United States to diversify its non-North American stroke China export markets, especially in Southeast Asia. Some colleagues of mine who are agricultural economists have suggested that ASEAN, which encompasses a number of fast-growing economies in Southeast Asia, who have a trade agreement amongst themselves, there's a strong potential for them to need protein to feed animals, and that soybean exports have the potential to get into that market. But would the US want to join ASEAN? And even if we wanted to join ASEAN, would ASEAN want the United States to be a trading partner, given that it's unilaterally raising tariffs right now? So it's difficult to see where US agricultural exports can be diverted to if there's widespread retaliation to the United States reciprocal tariffs. So my final thoughts, and these are rather specific to my own interests, is this thing called the GATT WTO has ensured trade policy uncertainty since 1947, and it's introduced a functioning dispute resolution mechanism since the WTO came about in 1994. But the system is clearly under threat, at least multilaterally, with the United States unilaterally applying reciprocal tariffs, which violate the most favored nation status rule and also the reciprocity rule and the fact that you bind your tariffs through the WTO. And both China and Canada have already filed complaints against the US at the WTO. But even if panels would rule in their favor, the US would likely appeal these into the void. And they already have appealed a ruling in favor of China back in 2020 into what's called the void. Now, this is sort of trade lawyer jargon for the following reason. So the WTO has a two-stage system. If you complain to the WTO, a panel may be instituted, and you can think of that as a lower court. That panel can make a ruling against a country, such as the US, for violating a rule of the WTO, which you remember is an international legal agreement. If the US did not like that ruling as the party being complained about, they could appeal that to what's called the appellate body. So that's like an appeals court here in the United States, or even the Supreme Court. And historically, there were 7 members of that court. So you needed at least 3 members in order for that body to make a ruling. But since 2019, the US has consistently vetoed new members. So the appellate body doesn't function anymore, which means even if the US were to lose a case to Canada and China at the WTO, they would simply appeal it into the void if they didn't like the ruling, and that would be it. There would be no appeal. There would be no appeal ruling, and it would just be out there in a legal void. So basically, the WTO is not really functioning properly right now. And my final point would be that we know that China has violated the WTO rules. There's no doubt about it. And there have been multiple rulings against them. And to their credit, they have actually abided by those rulings. But Jennifer Hillman's an extremely well-known trade lawyer. She's a professor at Georgetown University. She was the US nominee to the appellate body back under the Obama administration. So she's a highly respected trade lawyer. She knows what she's talking about. She gave congressional testimony in 2018, I believe it was to the US Senate, where she laid out all the reasons why China has violated the rules and why the United States, the EU, Japan, and other large trading partners should form a coalition to file one big, huge complaint against China. This is pre the first trade war. Sadly, I think that time to do that has passed because the US is taking a unilateral and very different position to trading relations to our major trading partners, the EU, Japan, and others who are also members of the WTO. So right now, and I will confess right up front to you guys, I'm a multilateralist and I'm worried about the breakdown of the multilateral system to which the US is largely responsible for starting that system, giving leadership in that system, and it led to a very large increase in global trade, tariffs were reduced, etc., etc. So maybe as a trade economist, you'd expect me to say that, but I thought it was important to finish out that starting a trade war has a lot of unintended consequences, in my opinion. So with that, Amanda, I will stop. And actually, let me just go back to sharing because I did have one more slide for you guys. I'm a professor. I can't help being a professor. So my last slide is I'm the nerdy teacher, and here are the references that you might be interested in. And those are live. You can click these and I'll send you these slides. So one is Chad Bound's trade war timeline, and he updates it regularly. The second is the paper out of North Dakota State that forecasts the damage from tariffs. And the final, I'm going to bang my own drum. This is a paper that got published the day the reciprocal tariffs were announced on the future of trade dispute resolution. So, Amanda, I talked for probably far too much, so I'm happy to take any questions.
No, not at all. It's perfect. We still have about 11 minutes of our time left. So there was one question in the Q&A box, which was asking if you'll share the slides. So I think you've agreed to do that. And I think you had mentioned, right, there are some slides that will be changing daily, right? So I don't know if there's a way to indicate in the version you send me which ones maybe are, only current as of today.
I will. I mean, it's very hard to keep up to speed with everything. And I think the bond price issue has softened a little bit already. So I'm keeping track of all of these things. So what would be the three key takeaways for farmers? One, it's going to put pressure on commodity prices. Two, it's going to speed up the rate at which we lose our third most important export market. And there's a risk that we damage our trading relationships with Canada and Mexico. And third, if you also take account of the import tariffs that affect farmers, this is going to put increasing pressure on farm margins, which are already under pressure even before the trade war. I hope that answers your question.
All right. Um, Again, you can use the chat box or the Q&A box. I'm also going to go ahead and allow everyone to talk if you would like to interact directly and ask a question. So let me just go through our guest list and do that. I will say if you have a outdated version of Zoom, it will not let you unmute. So you do have to have the most current version. But I am making my way down the list so everyone will have the ability to speak directly if they choose.
I recognize a few names on there. I see Amanda. I taught Amanda as an undergrad and a graduate. I see Alan Lyons managed to make it today. I think I recognize Molly Bean and some others on there. I can't believe Alan's not going to ask me a question. I guess I blinded you with science.
It's a lot of information,
I
but
understand.
very well done. I feel like, for me who has no background in this content, I was able to follow along pretty well. So, and I know you've gotten some positive comments, like what an eye opener from Susan. And Jennifer has also agreed that this was an amazing presentation. So,
Thank you.
um,
Appreciate it.
so I'll give one last call for anybody who wants to unmute and ask a question, or if you're currently typing into the Q&A box. Um,
Oh, I'm
Enlightening
sorry.
but terrifying.
I'm sorry that it was terrifying, and I hope I'm not. I don't mean to fearmonger, but I think that's kind of where we are right now. Can I ask the audience a question, Amanda?
Yeah.
I'm not going to ask farmers or anybody in the audience who talks to farmers about what farmers might think of the tariffs themselves, but how pessimistic are farmers right now? What's the feeling of folks online? Maybe I'm putting people on the spot. The reason I ask, I get a lot of journalists asking me this question, and I'm not as close to being on the ground there. I mean, my sense is from talking to journalists out in Indiana and other states that they think farmers are pretty pessimistic, but they're being a bit cautious about saying anything else right now. Maybe that's an overtly political question that I probably shouldn't ask. One thing I probably didn't mention, and I'm surprised nobody's asked me about this. This week, FarmDoc put out the prospective plantings of crops, and for Ohio, they're forecasting more corn is going into the ground. Sorry, in aggregate for the US, more corn, less soybeans. But for Ohio, soybean plantings are forecast to be up, corn plantings are forecast to be down. So I'd also factor that in when thinking about what might happen in the corn and soybean export market and the prices that I showed you towards the end of my talk. Seeing an interesting comment there. Without catastrophic weather events, crop farming will become unprofitable and we'll be losing our industry. So that sounds pretty, Julie Wayman, that sounds very pessimistic to me. Piece of hope, a ray of hope, maybe. I had coffee yesterday with my law school professor who I write papers with. I write with him frequently. We were discussing what was the plan for our new paper. It's already changed in the past 2 months, but he visits China regularly. He was originally from Hong Kong, and so he's a Chinese American, but he visits China regularly. He was quite optimistic, and he thought that China would want to strike a deal eventually with the United States. And he's more optimistic than I am, but we'll have to wait and see. But he thought, and he travels to China regularly, and in fact, he's just about to go back to China again. So he has his ear to the ground to the policy guys over there, and he thought that this was building up to some kind of rapprochement later in the year. So you heard it first from me, but you can blame my law school professor friend if I'm wrong. Okay. I'm seeing some more Q&A.
Yeah, there's one from Alan. It says, and I don't think everyone can see these, so I'll just read it. It says, will this activity change the sense of reliability of the U.S. for future source of agricultural product and therefore cause other countries to begin to produce these products?
Well, Alan, that's a really good question. Is if we can't divert our exports elsewhere and farmers face falling prices, and the law of supply says what if we continue to get falling prices, folks will plant less. I guess the question back to you, Alan, would be outside of Brazil and a couple of those Latin American countries. It's not obvious to me who else in the world has the ability to produce all of that corn and all of those soybeans. Obviously, on the wheat side, China itself produces a lot of wheat. Canada produces a lot of wheat. Australia produces wheat. Wheat is, one of the major subsistence commodities. I think that one we can see some adaptation, but on the protein side, particularly soybeans, I think we're going to have to rely on Argentina to be the future source of that product beyond China, as well as for China. But that's me just speculating, Alan. I think we're very dependent on technological change generating continued increases in yields outside of the United States, particularly in Latin America. And of course, climate change and the impact that could have over the next 50 to
Hey everyone, I thought it might have been my internet, but I think Dr. Sheldon got disconnected. So I see there was still a few questions in the Q&A box, and so we'll see if he's able to rejoin. Um, just not, I thought it was my internet at first, so we'll give him a second to see if he pops back on. And if he's not able to join us, I will go ahead and save these questions so that we can get them to him still and he can answer them. All right, well, I think we're just at about time. It's 1:29. Again, I apologize we lost our guest, but this is recorded. I will send it out through the listserv next week, and I will make sure to get those two questions that we missed answered. So hope everyone has a good weekend, and we hope you will join us next time. Thanks so much.